Good afternoon to all of our viewers. It is January 22nd of 2024. Hope that everyone had a great weekend. We have a lot to review this week. Markets have certainly been in this state of consolidation, which is understandable when we take a step back and we look at how markets ended the year last year. I believe it was something like 9 straight up weeks. Whenever you get a big move like that, you're going to have to rest for a little bit, right? And whether this market consolidation is a start of something further to the downside, that remains to be seen. We're looking at things, but when we look underneath the hood right now, we don't see anything that really stands out to us that would really give us significant pause or where we are losing significant sleep over. But we're going to go over all of that this week. And the title of this week's presentation is the yield curve steepening. Is that a friend or foe for investors? And the truth is, it can be a little bit of both. It depends. It certainly depends on where we're at in the business cycle, the nature of that yield curve steepening. Obviously, we'll review all of that in the presentation. So, three big things we want to do today. We're going to do a stock market and strategy review. Second, we'll review the bond markets. We haven't done that in a while. I think it's important to do that. They serve as the foundation for capital markets across the globe. And then lastly, we want to show and walk investors through some examples of selling the news. In many cases, we get caught up in a lot of the hype around certain asset classes. Hey, this is going to happen, therefore this is going to go up. We want to show a few examples of where that's obviously not the case, and that happens more often than not. So just a little bit of education for our viewers today. Now, just a quick reminder, that framework for 2024, we do believe as the yield curve starts to steepen, that will serve, or we believe will serve, as a catalyst to rotate assets out of those growth stocks that a lot of retail and institutional investors are piled in right now back into value. There's just a real fancy way of saying money coming out of the very, very top of the market and into the average stock. Those sectors and companies where valuations remain dirt cheap. They largely did not participate in last year's rally. So we see a catch-up trade there. That's something we're deeply focused on. So what's going to cause that? Fed shifting from attacking inflation to preventing inflation. Now, there's a nuance there, right? We're not in that camp of 8 to 9 rate cuts. We think that's a little bit of hogwash. We could see a couple rate cuts. We think the market's a little bit too aggressively skewed toward this 8 or 9 rate cut assumption. So we have to be careful with those growth assets that really depend on those aggressive rate cuts to be holding stock prices at those elevated levels. If we get 2 or 3, we actually think that serves the economy in a better way. We believe that doesn't necessarily get inflation expectations ramped up too far to the upside, and that could lead to some yield curve steepening. So as growth expectations rise, that yield curve starts to steepen. And when that happens, we do believe that value stocks, small cap stocks, will tend to, or at least we believe will tend to outperform their growth and large cap peers. Now, this is a chart that we've shown week in, week out, but we want to remind people that that rotation has already started in many ways. If we look at the small cap universe of stocks, so those smaller companies that are publicly traded, value small cap has significantly outperformed growth small cap really since the middle part of 2023. We did not see that on the large cap side. Why? Because of the Magnificent Seven. Tesla, Apple, Netflix, Google, you name it, right? Those 7 big stocks, NVIDIA, obviously a big one. Those ones continue to outperform. But we see those as increasingly the exception versus the rule in the growth versus value landscape. And eventually, we believe gravity will catch up to those very top stocks at the peak of the S&P 500. So that's something we want to be very, very, very mindful of in 2024. And what forms that worldview, of course, is not just that steepening yield curve, but where valuations are right now. So when we look at the S&P 500, the PE of different sectors within the S&P 500 versus their 10-year average, energy stands out as obviously one of the cheapest sectors, while information technology or tech stands out as extremely expensive relative to that 10-year average. You, of course, need catalysts to realize value. And we do believe that there are multiple catalysts within energy to unlock that value, and that there are multiple catalysts to reset technology valuations back to the downside. So right now, when we look at the markets, at this point, we just believe that we're kind of consolidating in an uptrend. 9 straight up weeks to end the year. And so you need to take a step back like a marathon runner. You need to slow things down. You need to pace yourself. And that's essentially what you've seen in the market. Tech started the year off weak, has bounced. Now healthcare is pulling back a little bit. So you're seeing this internal rotation as stocks try to catch their breath. Now, more recently, the percentage of stocks at 20-day lows has started to rise, right? Around 36%. When you're dealing with shallow or market consolidations or short-term sell-offs, once you get into that 36 to 50% range, that's assuming, and this is an assumption, assuming we're still in an uptrend, this is about the time when you would want to dip your toe in and start to buy some of these pullbacks. Now, if you're of the belief that we're going into a bear market, then you would want to sell any bounces. But if you're of the belief that we're in this uptrend, you'd want to use moments like this as viable entry points. And then we can see here, since the start of the year, we've had definitely some weekly outflows from equities. Now, this could be people delaying the selling through the end of the year because they didn't want to pay taxes right away, and now they're doing the selling. You do see some of that, and you see managers taking some gains. You know, the Magnificent Seven, they are up sort of 80% or so as a group. So definitely some profit taking there. And then where is the value in the market? Obviously, you know where our thoughts stand there. As it relates to recession positioning, a question we get quite a bit, we don't really see signs of that, whether that's in the bond market or within the equity market. When a recession's around the corner and investors are sniffing it out, 2 sectors tend to act better. One, utilities. Why? Because we need to flip those light switches on no matter what happens. Recession, expansion, our kids, ourselves, we use electricity. So utilities tend to act better ahead of recessions and through the first part of a recession. The other big reason is that utility stocks are basically like bonds. They don't have a lot of earnings growth to them. So you're basically buying a steady stream of earnings. And so when rates go down in response to lower growth and potential rate cuts responding to a recession, the value of those stocks tend to rise. What you can see here is that utilities relative to the S&P 500 continues to break down, both from an absolute price standpoint, as you see here, awful start to the year, and also a relative standpoint. The other chart here on the right is gold. So you can see gold looked like it was going to break out at the end of the year and has had a very significant sell-off as it relates to the gold stocks since the start of this year. We've seen a very big correction out of gold and gold stocks. Again, not very indicative of a lower rate environment. And we actually kind of see this as potential evidence that the market's sniffing out that long-term rates actually may be going up, not down, because gold tends to do better when real rates are lower, not higher. In other words, they're replacing paper. So what's the bond market telling us about recession risk? So 3 big things if we want to summarize the bond market. The US Treasury curve continues to steepen. We've been in a deep period of inversion for a long period of time. We did not get that recession that everyone was predicting. We're now re-steepening on that yield curve. Now, that can be good and that can be bad. We're going to go through some of the nuances there. Number 2, the risk spreads are narrowing across all bond classes. So whether we're talking high yield, investment grade, Europe, North America, those credit spreads continue to narrow. Narrowing's good. You want to see that. It means that people who are borrowing money or companies are borrowing money are paying less relative to the US government. We want to see that. And then, of course, the yield curve is steepening across the board. And you see that here with credit spreads. Credit spreads, if we look at high yield, in other words, junk bonds, those credit risk spreads are falling across the board. Same thing with investment grade, European high yield, and European investment grade. So risk spreads compressing, really calm conditions across the board in credit land. You did not see that ahead of 2008, for example, or ahead of 2000 and 2001. You saw those credit spreads widening as people started to anticipate a recession. You're just not seeing that right now. And obviously part of this, it does help that interest rates have come down, but these are the spreads. So the spreads are coming down despite the fact that interest rates are down. What's more interesting in the bond market is the steepening of the yield curve. Now, we have often shown the yield curve chart, but I actually want, sometimes if you're not a professional investor or you don't do this every day, that could come across as Chinese to you. You don't even know what you're looking at. So what I wanted to do today was show viewers the interest rate on the US 30-year and the interest rate on the 2-year. And what you can see here is over the last month, there's a clear divergence between how the 30-year is trading and the 2-year. The 30-year is quite clear. It's going up. Interest rates on 10 and 30-year bonds are going up. Interest rates on short-term paper are going down. So why is this happening? Why are short-term interest rates going down while long-term interest rates are going up? Well, this is how we have to understand the yield curve and why it's important. What we call this is a bear steepener. Now, that could be misleading, that name, but a bear steepener essentially means is when the yield curve steepens by rates going up higher on the long end than rates going up on the short end. And it's called a bear steepener because when rates go up, bond prices come down. That's bearish action for the price of bonds. That's why it's called a bear steepener. So the 2-year interest rate is most directly impacted by expected and actual Federal Reserve policy. So when we're expecting the Federal Reserve to raise interest rates, we expect the 2-year rate to go up, and it usually does if that happens. The 10 and the 30-year is a little bit different. Those rates are impacted by growth and inflation expectations, right? So if on the 2-year, the Federal Reserve are bringing interest rates or policy rates down, investors, if they are not seeing a recession around the corner and they see that as fueling economic growth through lower rates, then they may say, hey, guess what? Economic growth expectations are going up, inflation expectations are going up, therefore the term premium must widen on the 10 and the 30-year interest rate. And therefore you get higher 10 and 30-year interest rates. Hence, a breakout of the yield curve, right? And we'll go through what we think that means in a bit. But obviously, I wanted to pivot a little bit here and talk about energy. Energy is one of our overweights. It's actually been acting well, but in the latter part of 2023, call it around October, November, early part of December, it struggled. And part of it was this minor blip that we saw in inventories. And people, I think, across the board thought that, hey, this is the sign that a recession's coming and we're going to use less oil. Of course, we've been very consistent that that is not the case. We do not believe that is the case, and that we believe that inventories are on a longer trend downward. And what you saw, of course, is that it peaked at a lower high again when we look at this general trend for oil inventories, and we've seen a very significant decline in those inventories. Meanwhile, valuations remain dirt cheap. On the technical and trading side, the percent of stocks at 65-day lows in energy have crossed 50%. And that's usually, if you believe the fundamental story of energy or any sector for that matter, and you see that type of trade action, that's where you would actually want to step in and do some buying here. And we saw some great results out of the first part of the space within Schlumberger. That's obviously more on the energy service side. We think this is very indicative of rising activity in the energy space across the globe, rising investment that needs to catch up for 10 years of no investment. And we think that benefits the service names. And we do think that as the Middle East continues to deteriorate, there is a premium placed on safe, predictable hydrocarbon energy from North America, whether that's in Canada or the US, and we're invested on both sides of the border there. So that's why we do remain bullish there. Now, we talked a little bit at the very beginning here about, selling the news, right? Where a lot of times retail investors, institutional investors, they'll say, hey, Bitcoin ETF is coming, therefore I have to buy it when the ETF gets launched. And in many cases, the price anticipates that event ahead of time. And so what's interesting is the Bitcoin ETF got launched and so far is down 13.5% since that ETF did get launched. We actually think this is a major top for Bitcoin for what it's worth. We're not long, we're not short, but certainly if we had to, we would be more on the short end of that trade than the long end. So again, just a reminder that don't get caught up with headlines. Buy an asset because you like the value of the asset. You think the price is going higher for this reason, and you know the risk. Same thing if we look at maximum interest rate cut expectations, right? We talked a little bit at the beginning of the presentation about market believes 8 or 9 rate expectations. That has started to come down, and you've actually started to see growth stocks significantly sell off. With the exception of the Mag 7, you've really seen the average growth stock really sell off. ARK Funds was at the center of the growth investment universe. They're down 16.3% since late December off their peak. So an astounding amount of price correction here for some of these mid to larger growth stocks across the board. So what are the areas that we're focused on? As you all know, as that yield curve steepens, bank and insurance stocks, energy, and of course, small caps over large cap. So summary is that we believe changes in the air as it relates to the yield curve. Stock market is working off an overbought condition. Nothing that alarms us too much right now. We're monitoring it. Number 2, yield curve may shift or may herald a shift from growth to value. And lastly, just be careful with buying or selling headlines. So we got for you this week, 888-543-3776. Please feel free to reach out to us or reach out to your advisor and have a fantastic week. Thank you.